Why do the smartest investors wait for the market to fall, and what do they do at that point? They don't try to guess the bottom or rush to sell assets. Instead, they use the DCA strategy, but with one important detail. They add to it two simple tools that help them make decisions calmly even when the market is falling: the panic fund and the fire protocol. This approach allows you to not worry about whether you bought too soon or too late. You have a plan and you just follow it. This is exactly how Warren Buffett acted in 2008. While some were getting out of assets, he methodically bought up valuable companies. When the market recovered, those investments brought him nearly $10 billion in profits. He didn't try to predict perfect timing. He simply followed a strategy that works in every situation. And now I'm going to show you how that strategy can work for you. Imagine you decide to invest $3,000. Instead of investing it all in at one moment, you divide that amount into 10 installments of $300. You buy once a month, at the peak, at the declines, at the ups and downs. At first, it doesn't seem that profitable. After all, why buy on the highs if you can wait for the bottom? But here's the secret. It is almost impossible to guess the bottom. Even experienced investors rarely get to the perfect entry point. Now imagine two scenarios. In the first, you invest all $3,000 on one day when Bitcoin costs $40,000. A month later, it drops to $30,000. As a result, you lose 25% of your capital and sit in the black. In the second scenario, you use DCA. At the peak of $40,000, you invested $300. A month later, another $300, but at a price of $35,000. Another month later, $300 again, but at $30,000. When Bitcoin rises back to $37,000, your losses are minimal, or you even come out on the plus side. Why is this happening? DCA lowers the average entry price. You buy both high and low, but your entry point ends up being much lower than those who invested at the peak. Here's another example. Let's say you started investing $200 a month in an S&P 500 index fund in July 2022. The fund initially was rising, then fell down sharply, then recovered. In July, you invested $200 at a price of $4,110. In August, $200 at $3,930. In September, $200 at $3,570. In October, $200 at $3,880. You bought both expensive and cheap. But here's the important thing. Thanks to DCA, you bought more volume exactly when the market was down. And when it recovered to the previous levels, your profit was higher than those who invested all the money beforehand. Now, the main thing is how to calculate all this. To make it easier for you to manage your investments and calculate your profits, I have prepared an Excel file that does everything for you. The file has two tabs. On the Orders tab, you simply enter the name of the asset, the prices, and the amounts you bought. The table itself will calculate the average entry price and show the final result. On the Portfolio tab, you can see all your assets on one screen. Substitute the current price of an asset in the Orders tab, and the table will show your current profit for each position. This is not just convenient, it allows you to always see the real picture of your investments and understand how effectively your strategy is working. The DCA strategy works on a simple logic. You buy more assets when they are cheaper. Here's another fact. According to Vanguard, investors who use DCA were 27% less likely to sell assets at a loss compared to those who tried to catch the bottom. The explanation is simple. Regular purchases reduce stress levels. You stop wondering when exactly to buy and just follow the plan. DCA works especially well in volatile markets. Take a look at cryptocurrencies. Their prices ride a roller coaster, and anyone who has ever tried to catch the bottom knows how hard it is to do so. That's why DCA is the perfect strategy for a market with sharp fluctuations. It allows you not to be afraid of these movements, but on the contrary, to use them in your favor. But there is another important advantage. DCA gives you psychological peace of mind. Instead of getting nervous about every drop, you know that every price drop is just a chance to buy assets with a discount. So the question is, the next time the market crashes by 20 to 30%, will you be able to buy assets in cold blood, or will you panic? To avoid being lost in the chaos, smart investors create a plan in advance. It's not just a DCA. It's an entire system that consists of two main elements, the panic fund and the fire protocol. Let's start with the FIRE protocol. The FIRE protocol is a clear plan that defines in advance at what downside levels you'll start using money from the panic fund. It's a strategy that allows you to act cool and calculated at times when the market behaves unpredictably. When prices fall sharply, many investors start flailing around. Some sell assets to save the remaining money. Some start buying up everything in a hurry. But those with a FIRE protocol simply follow a predetermined plan. That plan is built on the principle, if X happens, I do Y. Here's how it works. You predetermine the levels of market declines and the amounts you are willing to invest at those levels. For example, if the market drops 10%, I invest $500. If it's down 20%, I invest $1,000. And if it's down 30%, I add another $2,000. Or let's apply this to Bitcoin. If Bitcoin goes below $60,000, I invest $500. If it drops to $50,000, I invest $1,000 more. And if it falls to $25,000, I invest another $3,000. The important point is that you set up this plan in advance when the market is calm and you have time to think clearly. The FIRE protocol removes unnecessary emotions from you at the moment of crisis. You don't have to guess the bottom or search like crazy for the best assets. You already have a plan. Just follow it. It's like an evacuation plan when there's a fire. When the alarm goes off in a building, no one stands around wondering where the exit is. Everyone just follows the predetermined route. Similarly, FIRE protocol turns the chaos in the market into a sequence of understandable steps. But there's an important point. FIRE protocol doesn't work without a panic fund. The panic fund is your financial reserve, set up specifically for serious market drawdowns. It's not the money you invest under a DCA plan. It's separate capital that you deliberately set aside to use only when asset prices drop significantly. Basically, the panic fund is your ammo, and the FIRE protocol is your plan for when and how to use them. One doesn't work without the other. If you have a FIRE protocol but no panic fund, you know what to do, but simply don't have the resources to implement the plan. If you have a panic fund but no FIRE protocol, you risk spending money randomly or missing a good moment altogether. Together, these tools create a system that helps you not just wait out unstable times, but use them as an opportunity for profitable purchases. Forming a panic fund is easier than it seems. The best way is to set aside a small amount regularly alongside your regular investments. For example, if you invest $500 monthly in a DCA strategy, add another $100 to the panic fund. This money is not involved in your regular investments. It just accumulates so that when the time comes, you can buy assets at a favorable price. The size of the panic fund depends on your strategy. Some people set aside 5 to 10% of their income. Some people focus on the size of their portfolio and allocate 5 to 15% of its value to the reserve. The main rule is that money from the panic fund should be available at any time. It is better to keep them in a separate bank account or in a cold wallet in the form of stablecoins. This will protect your capital from accidental spending and ensure quick accessibility when the time is right to buy. Panic fund is not about fear or expecting the worst. It's your strategic resource that allows you to act confidently and cost-effectively when the market offers the best prices. That's why experienced investors don't just wait for the market to fall. They prepare for it in advance. Let's take a simple example. Let's say you invest in Bitcoin using the DCA strategy. You buy $1,000 worth of Bitcoin every month, regardless of the exchange rate. Many people do this, and the strategy generally works. But now let's imagine that you use the same DCA, but enhance it with the panic fund and FIRE protocol. In other words, you still buy $1,000 worth of Bitcoin every month, but additionally buy $500 more if the price drops by 15%, and another $500 if the drop reaches 25%. What happens in practice? Over the course of a year, Bitcoin falls in April, July, and August. You implement the FIRE protocol and make additional purchases during these months. And here's the result. Average purchase price using classic DCA, $63,733. Average price using the FIRE protocol, $61,659. The difference is more than $2,000 per Bitcoin. You didn't predict anything. You didn't catch the bottom. You just went with the plan. And that's the whole point. When you have a strategy complete with the panic fund and FIRE protocol, you gain an advantage where others are just guessing. Buying in a falling market always seems risky. You think, what if I'm in a hurry? What if it's even cheaper tomorrow? But this is the one thing that's important to understand. You don't have to guess the bottom to invest profitably. The DCA and FIRE protocol are designed exactly to relieve you of that doubt. You have a plan, which means you don't have to guess. You bought when the market was down by 10%? Great. If it drops another 20%, you have a panic fund and a predetermined amount for your next move. If prices drop even lower, you're ready again. You're not looking for the perfect moment. You are acting on a pre-built strategy. A fall is not a threat, it's an opportunity. When you have a plan, you don't worry about doing something too soon or too late. You just take action step by step. You stay calm, cool, and confident. And that's how those who know how to keep their heads cold when others don't know what to do win. The market always fluctuates. It's not a question of when it will fall. It's a question of whether you're prepared in advance. The FIRE protocol is not a response to a crisis. It's part of the structure. The panic fund is not frozen money. It's a reserve that allows you to move on when others stop. The system works if you put it together before the noise starts. When you use the DCA strategy, you buy and just wait. But to earn extra, you can stake cryptocurrencies that run on proof of stake. And if you're holding SOL, you can use our Telegram bot that helps you keep track of your staking. It shows revenue per epoch, average APY, uptime, and validator efficiency. Just provide your wallet address, and the bot will show you how your stake is really performing and whether you can get more. The link to the bot is in the description. And here's another question: how to realize when it's time not to buy, but to lock in profits? In the next video, I'll talk about 5 key signals that will help you make that decision on time. In the meantime, write in the comments your FIRE protocol. At what levels do you plan to buy assets? Let's figure it out together.